The third and final section on this broad topic is about what the individual can do. Really, that's what matters most to us. Whatever scenario we talk about, whether it's outright default, whether it's austerity, or whether it is inflation, really the responses are kind of the same in our view. First thing you want to do is you want to try to diversify your savings to include baskets of other currencies. So in Canada right now, HSBC Bank offers the ability to save money in renminbi, in US dollars, obviously, in euro, in pound sterling, I think, and a few others. If you're in a situation where the value of Canadian government paper, whether it's currency or whether it's government debt, is dropping, you'll actually be relatively better off owning things like the CHF, the Swiss franc, or some other currency. So that's the first thing you want to do. Another thing you want to do, if we're in this default scenario, or we're in this inflation scenario, or this austerity scenario, is have some liquid cash available to you, maybe a 3 to 6 month emergency fund, and also pay down your debts. Because in a situation where we are either tacitly or implicitly defaulting on our debt through either default or inflation, the bond market's not stupid. They're going to demand higher and higher rates of interest to accommodate that loss of purchasing power that they're getting, which is going to drive interest rates. And so if you were in a situation where you have debt and the government is going to default in some way, that's going to be painful for you. So get out of debt as fast as you possibly can. It's not a sexy solution. It's not the kind of panacea that's going to create, a solution with no pain, but it is one that's very, very effective in a situation where you are in a country that's going to kind of default in some way. In terms of your investing life, which is my interest, you want to actually buy those Canadian companies that make most of their revenue in foreign currency and spend most of their expenses in Canadian currency, because they'll be receiving revenue in a valuable currency and their expenses will be associated with a less valuable currency, the Canadian dollar. So you want to look for companies that have that kind of a profile. Also, you want to look at put options. I talk about put options on this channel because if there's some kind of default, either immediately or tax rates go up or inflation gets ugly in Canada, the market here, the Canadian market, is going to drop. And so you want to get into put options. You want to sort of insure your capital in the way that you pay house insurance. So that's something you want to think about. Now, I know some people are going to say to me, if you're expecting inflation from some kind of a default scenario, why aren't you advocating gold and silver? As I said in the gold and silver series, there's no real good relationship between gold and inflation hedging. I think there are much, much better inflation hedges in this country available to people that actually pay income rather than cost income. So in an inflation environment, again, I would say cite my earlier work, do not buy gold in that circumstance because it's a silly investment. I wanted to end this piece on Canadian government debt by talking a little bit about the Canadian banks. If the Canadian banks default, I don't know how likely that is, but if it happens, I hope we as a society go the Iceland route and we don't go the Ireland route. Obviously there's differences between Iceland and Ireland. Iceland has its own sovereign currency, for example, whereas Ireland has the euro. But I think the way the Icelandics, or the Icelanders, the people of Iceland, sorry Iceland, I don't know how you call yourselves, but I think the way they handled it was much more intelligent than the way that the Irish handled it. The Irish really sort of screwed their own taxpayers, which didn't make any sense to me when it happened. So that's the first thing. The second thing about Canadian bank defaults, I've talked a lot about cocoa bonds on this channel, and I think they're terrible for an investor, but societally I think they're great because they impose the risk on the actual bondholder and they remove it somewhat from the taxpayer. Because as Mervyn King said, banks are international in life and national in death, which means that when they die, the people that they happen to be headquartered near are on the hook for that, and cocoa bonds go a long way to ameliorate that problem. So although I don't like cocoa bonds as an investor, societally I think they're fantastic, and I think they're a sign also that some bankers or all bankers have the ability to learn from crises in the past and develop solutions that can help us. They're kind of like microbial organisms that develop and show intelligence sometimes. It's really remarkable when bankers do that. So that's pretty much our piece on government default in Canada. We'll be talking about the United States in future episodes. Now, on a completely unrelated note, we have a Tangerine bank account, and I think we posted some stuff about this here, but I just want to be explicit about it. We have a Tangerine bank account that has a key associated with it, and if you are thinking of opening a bank account, please use our key to do that, because if you do, when you open your Tangerine bank account, you get $50 or $75. I think they've got an extra $25 they're giving you, and we get $50 or $25. We love providing this content, we love doing it, but if we could subsidize the costs of doing it somewhat, we'd very much appreciate it, and this is a sort of win-win way to do that. So you guys benefit by opening a Tangerine account, making yourself $50 minimum immediately, and we benefit as well. So thank you very much. The key to that will be in the list, in the link below. Thank you very much as usual for watching, and as I say, next time we want to talk a little bit about the implications of a US government debt, because that's a bit of a different scenario.